cold November evening in 1956, the most powerful man in Britain was not in London. He was in Washington, and he wasn't British. In Downing Street, Prime Minister Anthony Eden paced as telegrams arrived from across the Atlantic. British and French forces had just invaded Egypt to retake control of the Suez Canal. On paper, it was a demonstration of imperial strength. The Royal Navy was still formidable. British troops were advancing. But in the dealing rooms of New York, a different battle had already begun. Traders were selling the pound. The United States, under President Eisenhower, opposed the invasion. Behind the diplomatic language was a hard financial threat. If Britain did not withdraw, Washington could order the sale of U.S. sterling reserves and block British access to emergency funding from the International Monetary Fund. At the same time, investors were quietly moving out of sterling, fearing that Britain would not be able to defend its currency and finance the war. The numbers were brutal. Britain's gold and dollar reserves were draining. The Bank of England could raise interest rates and tighten credit, but that risked pushing an already fragile post-war economy into crisis. Continuing the military operation meant risking a full-blown run on the pound. Within days, the decision was clear. British troops began to withdraw from Egypt. Officially, it was a diplomatic adjustment. In reality, it was something more sobering, an empire discovering that its foreign policy now depended on its banker. And that raises a question most people never think about. What happens to a global financial system when the empire that designed it loses the ability to defend its own currency, but finds a way to keep power quietly, in a different form? What's interesting about the British story is not just that the empire fell, it's how familiar the pattern feels once you look closely. A dominant power builds a system the world depends on. At first, it's anchored in something concrete: ships, gold, colonies, taxes. Over time, the system becomes more abstract: credit, derivatives, offshore markets. Promises multiply faster than the underlying strength. Then a shock arrives. Each time, the same questions reappear. What exactly has been promised? What backs those promises? And who, in the end, is forced to step in when confidence breaks? You live inside the latest version of that story. Your pension fund in Canada, your mortgage in India, your savings account in Nigeria, your tech stocks in California, all of them are linked, directly or indirectly, to a financial architecture that still runs heavily through London. It no longer looks like an empire on a map, but it still channels other people's savings, other governments' debts, and a staggering network of contracts written in dollars and sterling. So here's the uncomfortable question. If the pound could be forced to its knees in 1956 by financial pressure, what happens in a world where London is at the center of an estimated $27 trillion worth of short and medium-term obligations that must be rolled, refinanced, or collateralized as interest rates rise into 2026? This video looks at that hidden connection, not as a doomsday prediction, not as a precise forecast. Instead, as a set of real historical tests, moments when British monetary power was stretched, downgraded, or reinvented. Moments that reveal how financial empires actually behave under pressure. We'll use those to make sense of today's invisible empire of contracts and obligations clustered in the City of London, and why a roughly $27 trillion refinancing wall over the next few years matters for anyone who uses money. To keep the story clear, we'll follow 3 stress tests. First, when the pound broke from gold in 1931 and Britain discovered that prestige could not override arithmetic. Second, when the post-war imperial illusion ended between 1956 and 1967 and British policy collided with the reality of dollar power. Third, when London reinvented itself as the nerve center of the offshore dollar system and how crises in 2008 and 2022 exposed the hidden fragility of a balance sheet empire. Each test will ask the same questions. What was promised? What backed it? Who was the real guarantor? And what broke when conditions changed? The first test takes us back to the interwar years. By the late 19th century, London was the world's financial capital. The pound sterling was anchored to gold at a fixed rate. British banks financed trade from Buenos Aires to Bombay. Holding sterling was almost the same as holding gold, with the added benefit of interest. Then came the First World War. Britain suspended gold convertibility in 1914 to finance the conflict. By 1918, it was heavily indebted, particularly to the United States. Prices had surged. The old pre-war parity between pounds and gold no longer reflected economic reality. Yet in 1925, under Chancellor of the Exchequer Winston Churchill, Britain returned to the gold standard at the old rate of $4.86 per pound. It was a signal. Britain wanted the world to see that nothing fundamental had changed. Sterling was still strong. London was still the anchor. But underneath, the foundations had shifted. To maintain that overvalued exchange rate, the Bank of England had to keep interest rates high to attract gold and capital. That made credit expensive. Exports suffered. Unemployment rose. British coal mines and factories struggled to compete. Investors noticed. By 1931, after years of strain and in the midst of the Great Depression, they began to doubt that Britain could sustain the peg. Gold started to flow out of the Bank of England. Foreign holders of sterling demanded repayment in hard metal, not paper. In September 1931, the game ended. The government abandoned the gold standard. Sterling fell sharply on foreign exchanges. Those who trusted the pound as good as gold discovered that the promise had been conditional all along. The lesson is stark. When defending the currency threatens domestic stability, prestige loses to politics. Gold lost to unemployment. Or, in a compressed truth, symbols can outlast strength, but not forever. The second test belongs to the era we began with, the post-war decline of visible empire. In 1944, the Bretton Woods Conference created a new monetary order, with the U.S. dollar at its center, convertible into gold at $35 an ounce. Sterling retained an important role, especially among Commonwealth countries, but it was now a secondary pillar. Britain, exhausted by war and burdened with debt, depended on American loans and Marshall Plan aid. The old imperial model of self-financing dominance had been replaced by something more constrained. Suez in 1956 exposed that constraint brutally. When Washington threatened to dump sterling and block IMF support, Britain realized that it could not both fight a war of choice and defend its currency without U.S. approval. The troops withdrew. The pound survived, but only with American tolerance. Just over a decade later, in November 1967, another blow landed. After months of market pressure, Prime Minister Harold Wilson's government devalued the pound by 14%, from $2.08 to $2.40. Wilson went on television to reassure the public that the pound in your pocket had not changed, only its external value. Economically, it was a necessary adjustment. Politically, it was another admission. Britain could no longer pretend that sterling was the equal of the dollar. The lesson of this second test is that sovereignty over your currency is ultimately about who provides the backstop. If your central bank can print the world's reserve asset, you can delay your day of reckoning. If you cannot, you rely on others, which leads directly to the third test, the creation of a hidden financial empire, centered not in the pound itself, but in London's ability to intermediate other people's currencies. In the 1950s, Soviet and Eastern Bloc entities wanted to hold and use dollars without placing those dollars directly under U.S. jurisdiction. European banks began accepting dollar deposits and making dollar loans outside the United States. These were U.S. dollars, but they sat in London, Paris, Zurich. The market became known as the Eurodollar market. London, with its deep financial expertise, favorable time zone, and increasingly light-touch regulation, became its main hub. By the 1960s, Eurodollars were financing global trade and investment. By the 1970s, oil exporters were recycling petrodollars through London banks. The British state leaned into this role, with domestic manufacturing in long decline and the old imperial trade network fading. Financial services became a strategic asset. Deregulation culminated in the Big Bang reforms of 1986 under Margaret Thatcher, which abolished many traditional restrictions in the City of London and opened the door wide to global investment banks. By the early 2000s, London was the largest center for foreign exchange trading, interest rate derivatives, and cross-border banking. The currency may have been the dollar, but the legal contracts, the traders, and often the balance sheets were in the city. Britain had lost an empire of colonies. It had built an empire of contracts. The stress test arrived in 2008, when the U.S. housing bubble burst and Lehman Brothers collapsed. The shock hit not just Wall Street, but the Eurodollar system routed through London. European and British banks had borrowed short-term in dollars to buy long-term dollar assets. They used complex derivatives to hedge and leverage. When dollar funding markets froze, they could not roll their debts. The assets they held could not be sold quickly without huge losses. The mismatch suddenly mattered. At that moment, the true guarantor of London's dollar empire revealed itself. It was not the Bank of England. It was the Federal Reserve. The Fed extended massive dollar swap lines to the Bank of England and other central banks, allowing them to lend dollars into their own banking systems. Without those swap lines, several large European and British institutions might have failed in a disorderly way. The pattern from 1931 and 1956 repeated in a new form. Once again, British financial power depended on an external backstop. Once again, complex promises had grown faster than their foundations. That brings us closer to the present and to 2022, when a very British crisis gave us a preview of the pressures building toward 2026. In September 2022, the UK government unveiled a mini-budget with large unfunded tax cuts at a time of already high inflation and rising interest rates. Investors questioned the government's fiscal credibility. Yields on British government bonds, gilts, spiked. But the shock did not stay neatly inside the bond market. For years, many UK pension funds had used a strategy called liability-driven investment, or LDI. To match their long-term pension promises, they held gilts and used derivatives to fine-tune their exposure. Those derivatives were leveraged. The funds posted collateral and promised to add more if bond prices moved against them. When gilt yields suddenly surged, bond prices plunged. That triggered massive margin calls on the derivatives. Pension funds had to produce cash quickly. To raise that cash, they sold gilts, pushing prices down further, yields up further, and triggering yet more margin calls. A feedback loop developed. Within days, the UK's long-term retirement system was at risk of forced selling itself into insolvency. The Bank of England intervened, announcing temporary purchases of long-dated gilts to stabilize the market. The immediate crisis passed. Once again, a pattern emerged. The surface story was a political misstep, a poorly timed budget. The deeper story was structural, a system of leveraged promises that could not handle a rapid change in interest rates. What happened in 2022 on a national scale is a microcosm of a much larger issue facing the global system into 2026. According to research by institutions like the Bank for International Settlements and the International Monetary Fund, by the mid-2020s, the world has accumulated tens of trillions of dollars in foreign currency obligations outside the United States. This includes bonds, bank loans, and, crucially, off-balance sheet exposures through foreign exchange swaps and derivatives. One BIS study in 2022 highlighted that non-US study in 2022 highlighted entities had tens of trillions of dollars in hidden dollar debt via FX swaps and forwards contracts that do not show up as conventional loans, but still require future dollar payments and collateral. If you focus on the volume of short and medium-term obligations that must be rolled or collateralized over the next few years, you arrive at a striking figure. Rough estimates suggest that by 2026, roughly $27 trillion worth of such obligations, a mix of foreign currency debts and derivative exposures, will need to be continually refinanced at interest rates far higher than those of the 2010s. Much of this web runs through London. Banks, asset managers, hedge funds, and corporations use the city as a hub to swap currencies, hedge interest rate risk, and tap dollar funding markets. The contracts are dispersed across the globe. The plumbing often terminates in a small patch of central London. The risk is not a single dramatic $27 trillion bomb. The risk is a rolling squeeze. As old debt matures and is replaced with new, more expensive debt, as central banks shrink their balance sheets, as volatility forces more collateral to be posted on derivatives, liquidity can suddenly evaporate in parts of the system that looked safe on the surface. By now, a deeper pattern begins to appear. In each era, Britain sat at the center of a system built on three layers. First, a widely trusted asset, gold in the 19th century, then government bonds and reserve currencies in the 20th and 21st. Second, a lattice of promises built on top of that asset, imperial debts, sterling balances, euro-dollar loans, pension obligations, derivatives. Third, an ultimate guarantor, the British state in the era of empire, and increasingly in the later 20th century and beyond, the United States and its Federal Reserve. Each time the system is stressed, the same logic reasserts itself. When promises grow faster than the underlying strength, someone must adjust. Either the asset is revalued, the promises are restructured, or the guarantor steps in. Sometimes all three. In 1931, gold convertibility was sacrificed to preserve domestic stability. In 1956 and 1967, imperial ambitions were sacrificed to maintain access to dollar support. In 2008 and 2022, central banks sacrificed previous commitments to market discipline in order to prevent systemic collapse. So what does that tell us about the $27 trillion question looming into 2026? It suggests that the real issue is not whether the British Empire will fall again. The map has already changed. The issue is how a global system, still heavily wired through the City of London, manages a world of higher interest rates, aging populations, and large hidden obligations without the kind of anchor that gold once provided. In practical terms, two simple truths emerge. Credit creates growth. Excess credit creates fragility. And globalization spreads opportunity. It also spreads shocks. For you as an individual, the takeaway is not to panic about a precise number, but to understand the architecture you live in. If your savings, your business, or your government depend heavily on short-term foreign currency borrowing, you are, in effect, exposed to that $27 trillion refinancing machine. If your pension or investments use leverage and derivatives to smooth returns, you are depending on a world where collateral is always available and markets are always open. We know from British history that those conditions hold until they don't. So, a few questions for you. If you were running a central bank today, facing this wall of obligations, would you prioritize fighting inflation with higher rates or preserving financial stability with cheaper money? Which part of this story surprised you more? The speed with which Britain's visible empire lost monetary control after 1914, or the subtle way London rebuilt influence through the offshore dollar system? And where do you think the real backstop lies now? In national central banks, in informal alliances, or in something else entirely? Most people drift through these shifts without noticing them, experiencing only the symptoms: a sudden job loss, a mortgage rate spike, a pension scare. A smaller group is curious about the underlying mechanisms: the gold runs of 1931, the Suez telegrams of 1956, the Eurodollar deals of the 1960s, the swap lines of 2008, the pension margin calls of 2022. If you're still here, you're probably in that smaller group. Studying these patterns doesn't give certainty, but it does give perspective. You start to see that empires don't just vanish, they change form. From maps and flags, to currencies and credit, to clearinghouses and swap lines. The British Empire fell. The City of London adapted. The numbers on the screens got larger. The underlying questions stayed the same. We'll explore more of these systems in future videos, because while the old empire has faded from the atlas, the financial pattern it helped create is still unfolding.